But I actually have something that's, I could call it a derivative of the opening range, but that would probably be a stretch. These are two, this is a system, or really an exploitation of a market edge that I wanted to share with you all today. And I haven't gone into it in this much detail in any other presentation. But it does deal with price action in very much the same way that we look at the opening range. So in that sense, it's a similar concept. All right. So for those of you, just quickly, for those of you who are not familiar with Market Gauge or me, just so you can have a face with the voice for the next 40 minutes. This is me. I come from Market Gauge. It's not just me here at Market Gauge. I've got a partner, Keith Schneider, who's been trading for 35 years, but I've been working with him since I started trading 24 years ago on the floor of the Commodities Exchange. Now, after working on the floor of the Commodities Exchange and being a floor trader, we both went up to a hedge fund by the name of Millennium Partners, which is a multi-billion-dollar hedge fund in New York that was primarily quant-based. And so part of what I'm going to talk about today actually comes from that hedge fund mentality and quant-based mentality. But in 1997, while we were at the hedge fund, we formed DataView LLC, which is really the parent company of MarketGauge.com, and we did it to distribute the tools and information that we were calculating for ourselves and our own trading to other professionals, and that eventually expanded into the environment of the active trader when the internet allowed us to do that. So that's a little bit about my background. But what I'm going to share with you today are what I describe as two trading edges. And there's always, at least I feel like, the word edge has been completely overused now in the market, but unfortunately it really is something that you want to focus on if you can do it. And I say if you can do it is because it does take a little bit of work, but sometimes somebody will give you one or two, and that's what I'm going to do today. But you still want to understand what an edge actually is. And two of them I'm going to focus on today are, one, first, what I call first new highs, and the second one, 6-month leaders. So the idea of an edge is that if you were to just enter the market in a situation where you have an edge, the best edge, I should say, the best edge is one where all you have to do is enter the market, and you could put your targets or your exits, your stops, your exits in the market at the same time, and the odds of you coming out a winner are very much in your favor. All right, so imagine it this way. If you had a list of potential trades or potential stocks, and there were 55 trades on that list, and you just threw a dart at the list, and however, wherever that dart landed, whatever symbol you landed on, that was the trade you had to take. Now, that's hopefully not how many of you view your trading, but if you don't know that you have an edge, that's pretty much what you're doing, right? You don't know that you're going to win or lose, and for most traders, you don't really know what the odds of the success really is. Now, I'm not saying that to beat anybody up, because I can tell you that I take plenty of trades where I believe that I have a understanding of which way the market tends to go after the specific pattern exists, and I know how to adjust my stops and my targets accordingly depending on which way the markets go, and in the end it turns out to be just fine. But that's really working the trade, and when you boil that down, you get a situation where you're a good trader because you can manage your trade to profitability. That's not what I'm talking about with an edge. What I'm talking about with an edge is you can throw a dart at your trades, you don't have to manage them other than an initial set of I'm giving you the ability to set a stop and set a target, and that's it. You let the trade run. Now, if you can put together a system by which you can do this with a defined list of symbols, and I'm saying define the list of symbols because that makes it much more repeatable. You won't have the condition whereby, well, I was looking at all the stocks in the universe, and I happened to find these 5 today. Tomorrow I might happen to find the other 5, but I didn't look at all the stocks the other day. So you know what I mean? If you got to come up with a consistent list of symbols in order to really test this out and come up with a true edge, which is why I say, this isn't necessarily always easy to do, but getting there, finding one doesn't have to be hard when you find it. So as a trader, before I even go into what these edges are, that really should be a goal of yours, to find a setup that is so well defined that you can go through the same process every day, find these symbols, and know that if you execute a simple set of rules, you will come up with a positive result. That's what we mean by an edge. So in this case, you got 55 trades, you throw a dart at it, you set your stop at a 20% move against you, you set your target at a 40% profit, and if you want to look at this visually, we like to display the trades in a visual way here, and this is a display simply of the fact that in this environment you take 55 trades, 70% of them were a success. The 39 winners means they reached their target of 40%. This represents your 39 winners, and this represents your 16 losers. Now, what does an edge look like? It looks like this, where you've got a much bigger area of winners than you do losers. It's really that straightforward. And in this particular situation, we're winning twice as much as we're losing. Even if we were only making 20%, which the line would put it right here, it would still be great, right? Let's just do some basic math. So if I take a sample of 10 of those trades, 70% are going to win. That's a $7,000 profit in total. 3 of them are going to lose. That's a $3,000 loss. That means on the 10 trades, it's a $4,000 profit. If I were to do all those trades at the same time, it would have required $10,000. Sorry, I'm assuming that I'm putting $1,000 into each trade. Would have required $10,000. On that, you make $4,000. That's a 40% return. All right. Now I say down here that assumes you're in all of them at once. If you're not in all of them at once, you might be able to recycle that $10,000, even not if you're compounding, just recycle it, and then your return on your money is even better. So when we talk about edge, when we talk about looking at the market, we talk about developing a system, that's what I'm talking about. And being able, and even being able to evaluate your system with a really simple way, like I've done here. Take 10 trades, make the numbers really easy, and just figure out what your ratio of winners to losers is, and look at your total amount that you need to allocate to it, and you can really quickly get a sense of whether or not your system makes sense. So even, and I should back up, this little exercise here of take 10 trades and figure out a rough way of figuring out the wins, losses, and total is a really good way to test what you're currently doing on the back of an envelope. And you can also play with it in the sense of, what if these 7 winners, we didn't take all the profit at 40%, instead we took profit at 40% on half and then waited for 60% on the other half, how does it work out? How does that really impact my bottom line? I'm not going to do that right now, partially because I don't have the numbers for 60% handy. But when you have that kind of data, you can quickly figure out, without really having crazy knowledge of backtesting software, to get a sense of what your trades are doing. Now, you can also do this by going back to your existing trades and seeing whether or not they make sense. You know, whether or not, had you traded them a little bit differently, you could have come out with a different result by doing basic math just like this. All right, so let's get to the edge itself. First new highs. Now, I'm going to preface this by saying I'm a little early in showing you this. Some of you might say I'm a little late in showing you this. I'm going to say hopefully I'm really early, but I'm definitely a little early. And what I mean by that is that the concept of the first new highs is one in which you're looking at the overall market. Now, in this case, I'm going to tell you to narrow the overall market down to the NASDAQ 100. All right? Sorry, not 100%. NASDAQ 100. The reason for that is because it makes what I'm about to show you much easier to execute. And when you're dealing with NASDAQ 100 stocks, you're dealing with stocks that are at least quality stocks. Nobody can guarantee that there isn't a bad apple in the bunch, but they have to be a decent market cap to get into the index. They have to pass exchange requirements to get into the index. They've been vetted, so to speak. So by just looking at these 100, remember what I said just a few minutes ago, you're able to define the whole universe in which you're testing your idea. So that's true of what I'm about to show you. So we went back to before 2008, and we looked at this particular edge in the market. And the edge is based on a really simple concept. After you have a significant correction, now for the purposes of this presentation, I'm going to call a significant correction a 10% correction. That's why I'm saying maybe I'm a little early, right? We haven't had a 10% correction in a while. However, in just a few minutes, I'm going to show you how you can use the same concept on corrections that aren't 10%. But when you have a really big correction, this is a really big edge. All right, now I'm sharing this with you. Part of the backstory here is I'm sharing this with you. This was shared with me when I was first came down to the floor of the exchange. I was trading commodities, had nothing to do with stocks, even though I loved stocks. Another guy down there by the name of Walter was a big trader, and he shared with me that in 1990 the market was set up in ways very similar to 1987 or after the 87 crash. And so he said, look, this is what I'm going to do. It's worked great in the past. It worked great. I made a boatload of money in 1987 doing this. Of course, I wanted to know what it was, and he explained it, and that's what I'm going to explain to you right here. After a major correction, the first stocks to make new highs that exceed the high that was put in before the major correction are stocks that you want to follow higher for a really simple reason. Obviously, they have something going on that the overall market hasn't gotten over. They're much stronger than the overall market. It's a form of investing in relative strength. But it's a very well-defined form because the new highs have to happen before the overall market makes a new high. Now, you might think this is too simple. That's why I have these numbers here. And you may also be thinking, yeah, but Geoff, we've been in a bull market ever since that. And that's true. This will work better if you have a bull market after a major correction. Well, I challenge you to find many times in history where after a major correction, we haven't had a bull market. Okay? Even if the bull market doesn't turn into one that's been as good as this one, there's a bull market. Not only that, as I said, I'm going to show you how this works pretty darn well, even without necessarily buying after a major correction. The concept is relative strength, and the real edge here is that you're able to really define which stocks you're going to focus on. So, for example, I should have had the chart up here sooner in the presentation, but if you look at the chart of NASDAQ, you had a high in about 2008, totally cratered, and it wasn't until about 2011, maybe November of 2011, that you just got back to that prior high. And then it spent most of 2011 whacking around before it really took off again. Okay? So it's in this time that we're looking at the number of stocks. 17 before 2010 broke out to new highs. So the Qs, or the NASDAQ 100, however you want to phrase it, same thing, were nowhere near their new highs when, but in that time, 17 stocks managed to get back up there. Now, if you were to take those 17 stocks and look at where they are today, you will have an average gain of 415%. If you look at those 17 stocks, and every time you bought one of those stocks, which was a new high breakout, you also bought the Qs, just to see whether or not you would have been better off buying the Qs, you'd be up 100, sorry, I don't have that number off the top of my head, but we can figure it out, because you would be up, the outperformance versus doing that is 119%. So in other words, the Qs are probably up just over 200% from that same time frame. You've doubled it. And every single stock is up. Now, again, you could say this is a bull market. Of course they're all up. That's not true. Not every stock that hit a new high is during that time, since that time frame, is up. In fact, you can see that as the date gets later, so 2012 is when I was saying the market essentially finally broke that new high. The numbers are still good, don't get me wrong. The average gain there is 194%. That's still 50% or 44% greater than if you had just been buying the Qs at the same time. So what am I saying here? You've got 93% winners, and you're doing 50% better than the market. But the cream of the crop is up here, the first ones to break. Now, this does assume that there was no stops, all right, which is a little unrealistic. However, the question is, are you fishing in the right pond? Right? Would you rather be out there, remember my analogy of the darts, would you rather be out there trying to figure out what stock to buy out of a whole host of other criteria with no necessary understanding of whether or not you got any bias that's going to outperform the market? Or would you rather focus on 17 stocks that over this time frame are going to have an average gain of 415%, more than double what you're going to get if you focus on the Qs? Now, throw a stop in there. Let's say you have a 20% stop, and only one of them got stopped out. Let's go to a chart to just take a quick look at a summary of what these trades have looked like. So the one that got stopped out is currently up about 30-something%. There's one that's been worse. It's just up a little bit right now. We'll call it basically a scratch. Everybody else is. They get to 200% pretty quickly, and they go as high as almost 1,200%. Now, that's where they are currently. That's not how high they have been. Some have been higher. So what's the point? right? The point is that if you want to identify stocks that have really got the wind at their back, identifying the ones that are breaking out before the overall market, after a major correction, before the market correction has to be at least 10%. The first stocks to break out before the market reaches the new high, right? That's critical, before they reach the new high. And then you can apply the stops and targets as you wish, right? I've put a 20% stop in there to give the stock enough volatility around that high to demonstrate that there's a real edge. So does that make sense? Before I go and look at what this means actually on a chart, does that make sense to everybody? This is a way of identifying market leaders by letting the market tell you who's leading and letting the stock not only demonstrate that it's gone up, right? Remember, this isn't just a stock that's gone up. This is a stock that's taken out its prior high. Okay. So just to make sure that we're clear, and here are some of the examples of what this means. So sorry, I said 2008 early. So end of 2007 was the ultimate high before this 50% pummeling that the market took. Now, if we look at Netflix, Netflix's high actually was 2008 sometime. But when the market cratered, Netflix was unable to make a new high until this horizontal line here. Now I bring the horizontal line in because this way you can see that even though the market was basically coming off its bottom. Now at this point, I don't know how many of you were focused on the markets at this point, but if you were involved in the markets here, it was not easy to be thinking, okay, this is obviously a double bottom that's going to go on to make 89% over the next 2 years, right? That was not easy to assume. But Netflix was breaking out. So this thing was probably still down 30, well, from 55 down to, let's call it 35. It's down over 30% from its highs. Netflix is breaking out to new highs. That's the pattern right there. That's an ideal pattern right there. It's the first one. It may have been the first one. And I think actually Netflix may have been one of the ones that was the 1,000% return. I don't remember. Now, it's not necessarily going to go straight up, okay? So you want to give it the flexibility of a wide stop, or I shouldn't say that, because you really can trade these in a number of different ways. If you're a more nimble trader, then this is your focus list to be focused on as they're breaking out, and we'll talk about this in a second when I get into more recent charts. As they're breaking out, you can set tighter stops if you want. But the edge here is that this pattern is telling you that Netflix is a real winner and it should be given room. And if it pulls back, anytime it pulls back and you want to hold back, fine. But when it starts to reassert itself again, you want to pay attention to it, because you should not at all be surprised if it has a move like this or even a move like this. I mean, this chart is so scrunched because we're talking about going from 40 to 240 in a matter of 2 years. Okay. Meanwhile, NASDAQ still hasn't even gotten back to its highs yet. Now, clearly, they're not all going to do this. All right? So the 337% is compared to the 89%, and this line here is when the Qs finally make it to their new highs. All right? So that's the concept. Let's take a look at a few more. GMCR. Now, GMCR you can see happened at right about the same time, if not the same week. But GMCR is an example of what can easily happen and often does, and that is that once it broke out, it never did pull back. It just kept going. Now, it's helped by the markets, okay? It's definitely helped by the markets, but one way, or one thing you should anticipate when you're trading new high breakouts like this is that if the Qs did not continue to grind their way higher and instead went down and put in a triple bottom, if this is a good trade, it's going to hold up, but it's not necessarily going to hold its highs. It could pull back, right? It could pull back. This particular recovery in this situation had the benefit of once it started to go, it continued to go. But there, keep in mind, these stocks did not break out over here before the market made a new low or tested its low. All right? I don't really think that's an accident. Right? Stocks starting to break out to new highs when the markets are over at their new at or near significant lows are stocks you should be focused on. So GMCR, you can see by the time the Qs got back up to their just peeking their head above their highs in the beginning of 2011, this one was already up 257%. Let's take a look at Priceline. Another example of one. Now this came later. The other ones we looked at were down here. This came later in NASDAQ's rally. But you're not focused on it until it breaks out to the new highs. All right? And if you waited till that, now, I know some of you might be thinking, well, yeah, Geoff, what about all this? I missed all this. All right? If you try to catch this, the low, I shouldn't say this so assertively, but trying to pick a bottom is much more difficult than identifying the exact condition for the entry when you're breaking out to a new high. Okay, the rule here is really simple. You've taken out the new high. The rule for buying a new low, not so simple. All right, not to mention you're going against the grain of the market. And hopefully 17 trades, 100% of them are higher, and 20% as a stop, you never got stopped out more than once. Those are pretty compelling stats to have as your edge. If you can find those same stats buying lows, then by all means, do it. My presentation here today is, can you identify a particular setup that'll give you that kind of an edge? And if you can, you've got, after that, finding the trading rules to make it work is not nearly as difficult as fishing around trading rules to try and get them to make money in basically any kind of an environment. Does that make sense? So Priceline, nice run, to say the least. 206% at the same time the Qs were up only 40%. So putting the odds in your favor, that's what we're talking about here. Those stocks came out of this group right here. And as I kind of jumped the gun earlier, if you were to take all these stocks, so now you extend it to 2012, now you're going to have 55 trades. Now remember, we're only looking at the NASDAQ 100, but keep in mind that between 2008 and today, there have actually been 200 stocks in the NASDAQ 100 because they come and they go. These stats that I'm giving you have looked at clean data so that we're looking at all the stocks that were in the index at all during this period. So we're not just looking at the stocks that look good now and assuming they were in the index back then, because I think the number is that at the lows of 2008 versus today, there's only 48 stocks that have been in there the whole time. So the stock list will change, but these numbers have accounted for that. And again, I'm only looking at the NASDAQ 100, and that's why you might look at this and say there's only 55 trades over this really more than a 3-year period, because we're talking about 2008. It took until 2010 for stuff to start breaking out, or 2009. So 55 trades over this time frame, as you can see, your edge decreases. Now, part of this is due to time. They don't have quite as much time for the gains. But you can see that if you had a stop of 20%, your percent wins goes down as well. All right. You can also see that your outperformance relative to the Qs has gone down. It's still not bad. If I told you, look, I have a system and it's going to beat the Qs by 50%, and you're going to win 93% of the time, I don't know that anybody should be complaining about that, right? But it doesn't look as good as 100% and more than double. All right, that said, you know, you got to play with the deck the cards that you're dealt. Right now, we're not. Maybe some of you right now are wishing that you were in the depths of 2008, 2009. I doubt it if you lived through it or if you traded through it. It was pretty tough period. So let's take all those trades, and I did already explain this to you, but here's what I was talking about earlier. If we look at all these trades that up until the point, this is why I'm picking up before 2012, because in 2012 the market really took out what was that prior high. All right, spent all of 2011 trying to make up its mind, trading above it, but it wasn't until 2012 it was really breaking out. So in this kind of an environment, just looking at new highs doesn't give you much of an advantage. It gives you an advantage over stocks that aren't making a new high, but it doesn't give you the same advantage as the overall market hasn't made a new high either. I've always been a big fan of looking at new highs for places to hunt for strong stocks. And there's a lot to be said for that in general. But when the overall market is doing it, it's much less of an edge. And so the stats here you can see, again, 20% stop, just let them run until now, 176% average return. Now that includes all your stops. All right, so, and here's the chart. I'm going to blow this up, but we're looking at, so this chart, which I'm going to blow up here, is going to be all the trades that happened before this time. All right, 55 or 56 of them we'll see on the next slide. So 17, it looks like, maybe 18 losses of 20%. And if I take that 20% number and draw it over here, this area above here is essentially your edge, okay? So that's pretty compelling. All right. Now, I'm sure there are quite a few people here who shudder at the idea of buying new highs. I can understand that. If you don't limit your risk, or it's not your style, then it's tough. If you don't want to buy the new high, right? And again, this 20% is also a big stop if you're doing really short swing trades, short-term swing trades. But I go back to the concept of where do you want to find your trades? Do you want to be looking at, let's use the NASDAQ 100 as your analogy. Do you want to look at all 100 stocks, or do you want to focus on a handful of stocks that are in this group? All right, I think you want to focus on these, even if you're doing shorter-term trades. All right, so like I said, now you know why I said earlier I might be a little early. I don't think I'm late. Hopefully I'm early, and hopefully you'll remember this when we have a major correction. But until then, what happens with shallow corrections? Okay, you can see this will still work with a less than 10% correction. It's just better when you have deeper corrections, right? Now, again, I don't have the stats to give you the edge, but let's just take a look at the charts and you can see how it plays out. So what I've done here is I'm looking at corrections that would have been the one that happened in October, and this horizontal line here is showing us when the market finally recovered. And then I put this horizontal line in here to illustrate when the market peaked out, because we have this correction in here. So by doing that, and this is what I would recommend, this is how you can do this on your own charts. All right, take a list of the NASDAQ 100, put it in your watch list, pull up a chart where you can pull up both charts on one, which you can do in any platform, and you should be able to put a horizontal or a vertical line at the key levels. So if we were doing it, and I probably should have done that with this here, so for right now, you'd put a vertical line in here too, because that's where the Qs topped out. Anything that's breaking out to new highs after this line right now, you want to focus on. But right now, we're going to focus on this line. Anything that broke out to new highs after that is doing the same exact thing that I'm talking about. Even better if you can get the new highs going all the way back to the left. All right, so Kraft is a really good example of one that breaks out really strong. Now, even if you don't want to buy it right here, okay, focus on this stock when it pulls back. You had a lot of time, right? You had a lot of time where the market was doing nothing, and Kraft was the right place to be. Let's take a look at another one. EA. Okay, market puts in its high right here. EA takes out its high right here. Again, nice pullback in here. So at this point, you have a really good example of the market getting hit really hard and EA holding its breakout based on this pattern. All right, the market whacking around down here and EA holding up. This is a stock you want to be focused on this whole time. All right, now the simplistic system would have been to be a buyer through this high with a really wide stop. Now, the edge, however, remember, is not going to be as strong as I just illustrated going back to a really steep correction. But focusing on this stock as the place to do your swing trades is a really easy edge to have. FISV, all right, here's its high. It breaks out on this rally here. All right, now, this is a really good example of following these things. So when it breaks out here, I'm going to say it's anticipating that the market's going to break out, but the market doesn't break out. The market goes back down for another trip to the basement. You have to expect.
I don't mean to interrupt, but you're looking at about 2 to 3 minutes remaining.
Okay. Thanks for the heads up. You have to expect that it's going to pull back. All right, and so with the right trading tactics, you can account for that. You can trade around that. So clearly I've got to speed up. Let's take a look at some that have happened right now, or that are working right now. I'll go through them quickly. You can get the recording and follow up on it. So this one, DLTR has broken out. The market's still sitting here. This is one you want to focus on. This is one you would have been wanting to watch for a potential breakout a few days ago. No worries. You'll be able to apply this in the future many times. Can you see how Mylan is now breaking out ahead of the market? Can you see how Paychex is now breaking out ahead of the market? All right. Do you see the pattern? All right. Now, unfortunately, I ran out of time for the second thing. I was shooting for 1 o'clock, but that's okay. A similar concept is to look at the NASDAQ 6-month leaders. Now this is not new highs, this is purely what has the stock done in the last 6 months, what is the leading stock based on a percent price change. If you do that, you will gain another edge. I'm going to skip that. And here's what it looks like. Since 2009, swing trades have been up 349% versus the Qs up 178%. And if you had a system whereby you bought the stock when it was the number one at the end of the month, so the first day of the next month you're the buyer, and you put in a 15% stop, and as long as that's the number one, you have 57% winners. Your average win is 12%, your average loss is 8%, and you get a profit factor of 2. A really basic system gives you an incredible edge. And this is the system right here, what I just described. All right? If you look at it over my PowerPoint, if you look at it over my PowerPoint, just bombed 1 second. I'm still here. Okay, so if you look at it over a longer period of time, you get a 54% win rate, a 19% gain, average gain, and 11% average loss. Again, a profit factor of 2. And if I just take the example, if I just took all the stocks that qualified over 2014, this is what they were. Facebook, now Facebook actually started its trade in December of 2013, so I included it. Facebook up 33%. In the same time frame, the Qs were up 1. Lumen was a loss, minus 2%. At the same time, Qs were up 2%. See where I'm going with this? GMCR up 13%. Intel up basically market. Vertex up 19%, Monster, which you're still in, up 37%. So with the exception of the loss, pretty much everyone either matched or beat the market markedly. And this is all linear, okay? So first you make 33, then you lose 2, then you make 13, then you make 4. Assuming no compounding, that's 104% versus a Q's 22 at the same time. Again, where do you want to focus your attention? Stocks that have that kind of performance, or try and find them some other way. All right, so that was a fast forward to the end. But fortunately, I don't have anything to sell. Okay, I'm not pitching anything to sell here today. But if you like what you've seen here, we do happen to have a webinar that's going on tonight as well. And I know you guys will probably be pretty burnt by the end of the day. But you can register. Maybe there'll be a recording, but we're going to do it. I don't know that we've announced it yet. We've just decided, because of the popularity of the webinar, we're also going to do it tomorrow at 1:30. You'll find that webinar registration at this link, marketgauge.com/the big edge, or big edge. Okay? Now, in that webinar, we're going to go into a more, even more robust system that looks at edges like this. It's not the same exact edge as the 6-month edge, but it's similar to it. It looks for momentum in stocks right now, and its performance since 2008 is up about 450%, as opposed to the Qs, which is down here around 150%. And you can see from an equity curve point of view, it's a pretty smooth ride. All right, so if you're interested, like I said, nothing to sell, but I would strongly encourage you, if you're interested in trading a mechanical system with NASDAQ 100 stocks, high quality stocks with good volatility, check out the webinar at marketgauge.com/big edge. All right, any quick questions? And Reed, just kick me off when you need to kick me off. I apologize. Thought I had
Yeah,
to.
we are unfortunately out of time right now.
Okay.
Probably do one if it's a quick one.
All right. You can use options with this for sure. You do need to navigate them, but I know that's a big question. Market gauge, you may have spelled gauge wrong. Let me put it that because that's a common mistake. Let me put it in. A common mistake would be to spell it GUA, and it should be www.marketgauge big-edge. You know what? You're absolutely right.
Yeah, I thought I put it in there correct.
Big edge. All right. Well, it worked before I came on. It's not working right now. I will make sure it gets fixed in the next few. You know what? I know what it is. It's NQ/big edge. All right. So right here, you want NQ, then big edge. And my bad, my developer will switch it. We'll switch it so that it works with just big edge in just in a few minutes. But in the meantime, if you want to get in, I'll put it in the chat or in the box right now. And Reed, I apologize, I got to get off. You've got it right now, marketgauge.com/NCQ/big edge. That will work. And thank you, Reed. Sorry for running over. And I appreciate everybody's time. Again, if you have any questions, info@marketgauge.com right there at the bottom will also work.